Hi, I'm Kevin Knaus with InsureMeKevin.com, and today I wanted to go over the modified adjusted gross income, which you need to estimate for the health insurance subsidies, either through healthcare.gov or your state exchange, such as Covered California. Now, when I go through the application with a client, this is one of the sections we spend the most time on because estimating the income for the next year before you've done your taxes for the year is very important, because if you estimate too high, you're leaving money on the table in terms of getting a subsidy. If you estimate too low, when you do your taxes for the year, you may have to pay back some of those subsidies, if not all of them. And some people have very complicated tax returns and income, so it's really important to spend some time on this. Now, it is called the modified adjusted gross income. And part of that is easy to find. It's the modification that can be difficult. Now, all of the information that I'm providing today, I'm not creating out of my own head. These are from documents published by the IRS, such as instructions for Form 8962, which is the form you actually reconcile your advanced premium tax credits on when you file your taxes. If you're using a computer program, you don't know that that's what's happening, but that is what's happening. And also Form Publication 974, which is the premium tax credit. And it's a very long document, and it really talks about the premium tax credit, how it works and everything. And I've also am using information from Covered California on countable sources of income. So I'm pulling this all from sources that are put out there to help consumers estimate their income so they can get the proper subsidy amount. So let's break this down. The first part, let's look at adjusted gross income, because that's what most people rely on. And your adjusted gross income is shown on your tax return. For 2019 is going to be line 8B. It says, this is your adjusted gross income. And now it is pulling in information from the lines above that, like your interest and capital gains, but it's also pulling in income information from Schedule 1, which, and they've redone all of these tax forms, so they can be a little bit confusing. But Schedule 1 has other things like alimony received and other gains and losses, rental and real estate royalties. So all of those other schedules, Schedule D, Schedule E, Schedule C, go on to Schedule 1 and then filter over into that line 8B. Now, one that I really wanted to bring attention to, because most people I work with are self-employed, is the Schedule C, which is profit and loss from self-employed income. And this one is really important because sometimes we just don't really understand everything that's going on. But I'm self-employed. Now, I have a gross revenue, which in 2019 was about $60,000 from insurance commissions and my website and book sales. But that's not the number I'm going to use to estimate my income, because I need to subtract my expenses from it. And that's what Schedule C does. It subtracts your expenses from your business income. Things such as, your communication, your internet, office supplies, travel, all of that gets deducted and then put on Schedule C, which is fit onto Schedule 1, which then goes on to your adjusted gross income. So you need to take some time. And if you're not familiar with your taxes, think about your business, your gross revenue, and the expenses. And if you have your tax return, you should be able to dig down into Schedule C to see exactly what that is for the purposes of putting that estimate into your account for the health insurance subsidies. Other adjustments that go into this on your adjusted gross income: when you make a contribution to a health savings account, you get to deduct that. You get to deduct part of your self-employment tax. And also, and this is a tricky one, In certain conditions, you get to deduct a portion or all of your self-employed health insurance costs. Now, that isn't the full rate if you're getting a subsidy. You're only deducting that part which you're actually paying to the carrier after the subsidy. And this can change. There's a circular reference that goes on between that and Form 8962. It gets really complicated. The IRS is aware of it. If you have any questions, go ahead and call me. But it usually gets, pulled through when you do your taxes. But all of that goes to reduce your adjusted gross income. So generally what happens is most people are estimating their adjusted gross income for the purposes of the subsidies a little bit high, because then they make contributions to the health savings account, or they get to deduct that health insurance premium, which reduces it when they do their taxes, which means they get a little bit more tax credit when they do their taxes for the next year. One thing I will add, they did change the rules. So if you have a divorce or a separation agreement that occurred in 2019, the alimony payments are not considered income, and they are not considered a deduction if you're paying them. So that's one thing. But again, talk with your tax preparer, because that can be a little bit tricky and it's very, very date sensitive. Now, that's your adjusted gross income. Easy to find, generally line 8B. But now we need to modify that AGI. And from the IRS, they have a definition, and it is the AGI subject to foreign earned income, tax exempt interest, and a portion of Social Security benefits that is not taxable. All of that essentially needs to get added onto your AGI. So the AGI is modified by Social Security. And this is the retirement or Social Security disability insurance payments, not supplemental security income. So, for instance, you have someone in your family, in your tax household, because all of this revolves around your tax household, the people that live in, is on your tax return, just not live in your house, not your roommates. Let's say your spouse is on Medicare, doesn't need health insurance, and is drawing Social Security retirement benefits. You need to include your spouse's Social Security retirement benefits in that modified adjusted gross income estimate on your application for health insurance subsidies. And that's really tripped up a lot of people that were unaware of that. So when they go to file their taxes, that Social Security retirement benefits that person received is added in, and it may put them over 400% of the federal poverty line, which triggers that you must repay all of the subsidy you received, because there are no subsidies on the federal side if your income is over 400% of the federal poverty line. You add into tax exempt interest, you add that into your, for your modified adjusted gross income and foreign earned income. So your modified adjusted gross income is larger, or can be larger, than just your adjusted gross income. And those are just really important scenarios that you need to think about. Other issues that can trip people up and cause a lot of confusion are the people on your tax return that may have had income. And the IRS says that you only need to include your dependent's income if they meet the tax filing threshold to file income tax return. So if you have a child that is going to college, works a part-time job, they will file a federal tax return to recoup the withholding, but they may not have made enough to actually have to file. That income wouldn't be counted. But if they had a really good job and they met the tax filing threshold, that income of that dependent in your tax household, that income must be included in the modified adjusted gross income. So a little complicated there, and yes, it makes your head hurt. So another way, looking at it a different way, is this all comes down to taxable income. Let's say you don't have any muni bonds that have tax exempt interest, and no one is collecting Social Security, and you don't have any foreign earned income. We're looking at your income that you must report to the IRS as taxable income, to calculate your adjusted gross income. Gifts are not generally taxable. So if your parents are paying you so much out of the goodness of their heart, and it is a gift, that is not income. Distributions from an IRA, depending on the type of IRA, can be included as income. Prizes, awards, rewards are usually taxable. My son got a chemistry prize through his college, and lo and behold, he had to claim it as income on his taxes. So he got a 1099 for it, so that had to be included. Cancellation of debts, sometimes that can be considered income. Gambling winnings, lottery, raffle prizes, so that kind of stuff needs to be reported, but of course isn't generally, those are kind of rare events. Insurance benefits generally are not taxed unless someone else has paid for the policy, such as a disability policy that you may have received at work. Your employer pays for it, maybe you're disabled. Those insurance payments can be taxed. You'll need to confer with the carrier and make sure. Annuities, sometimes part of that annuity payment can be taxed. Usually if you're receiving principal of the annuity, that's not taxed, but interest is. So again, confer with the people who handle the annuity and that retirement fund to see what portion is taxable. Child support is not considered taxable income. In-home support service payments in California, if you are caring for a child with a disability or a family member and the state pays you an hourly wage to take care of that person, the IRS has ruled that's not something you put down on your tax return. That may be different in other states. I'm not sure. Again, confer with your tax specialist, but we're trying to focus on things, income amounts that you have to report as income. And getting back to self-employed people, it can be tricky because you don't know. You could have a huge loss at the end of the year that you didn't anticipate. Maybe the truck blew up, and that's going to affect your estimate of your earnings for the year. It happens, and sometimes you can't plan for that. And you can't plan if you land a big contract and all of a sudden you get an advance on that. That's going to push your income up. So you can't necessarily plan for all of the different variables. You are giving your best good faith, honest estimate of what you estimate your modified adjusted gross income will be for the next year. And it's difficult. But you can use that AGI from the prior year on your tax return to help guide you with the estimate for the upcoming year. And then just always kind of just have it in the back of your mind. And when things change, try to get into your account and update it, or work with your agent to update your account so that you're getting the proper subsidy and you don't have to repay a whole bunch or get a huge credit and you left money sitting on the table. So hopefully that's helped you. My name is Kevin Canals, insuremekevin.com. You have a wonderful day.